Well, our product suite into China continues to flow exceptionally well. We've been operating now for 21 years, and the majority of our product, nearly 90%, goes into China. And our product is known for its reliability in terms of product quality and also delivery on time. And we've historically had very low stocks of our product in ports in China, which is an indication that our product flows very well.
How does that reconcile with the warning from one of the world's largest steel producers that the sector is facing a harsh winter, prompting concerns the downturn could overtake those from 2008 and 2015?
So I was actually in China when the chairman of Baowu made those comments. And it was really quite interesting because he also talked about a plateauing of steel demand. Iron ore demand because of a plateauing in steel consumption. Now, I just want to remind all of our viewers that plateauing is at around 1 billion tonnes of steel production out of China. Those levels are extremely healthy for iron ore producers here in Australia, and particularly us, where we enjoy a privileged position of being at the very bottom end of our cost curve.
A recent report by Goldman Sachs says only 1% of Chinese steel mills are profitable. The current export volumes can't continue, can they?
So certainly we've seen margins across the steel industry not change significantly over many years. In fact, steel mills in many parts of China form the anchor to industry jobs in many of those provinces. And many of those towns and cities are built around the steel mill. So we are confident that the steel industry will continue in China over many years to come and continue to provide demand support for iron ores around the world. Again, come back to, though, that demand support is changing to a green supply of iron ore and also a green metal supply as China's own industry transforms its energy profile.
Fortescue has pushed out its green hydrogen targets because of the cost of a key input, electricity. Fortescue says it's too high. When does the company expect the price of electricity will be right?
It's a great question, and I think it's one that really all of us in Australia need to take very seriously. And certainly from an industrial perspective, getting our renewable energy costs down is going to be so important for that next boom of commodities. And for me, it's about green commodities. What we now have to do is work together with government and industry and community like we have never done before.
And so when will the stars align for green hydrogen? Is it going to be in the 2030s, the late 2030s? When?
Well, we're certainly seeing the stars aligning now. In many jurisdictions around the world, our projects, for instance, in Norway and Brazil, the stars have already aligned, where the cost of renewable energy is significantly cheaper than its hydrocarbon counterpart, which makes the downstream industries of making green fertilizers, green ammonia, and even green metals in other parts of the world very attractive. This is the time where we have to act and not miss this opportunity.
Are you saying Australia is at risk of letting this opportunity pass by? How big is the window?
I think we have a bit of time. The iron ore industry is a huge industry. The steel industry is a huge industry. It will take time for the steel mills to convert to green energy. You're already seeing signs of that where China is investing in Saudi Arabia, investing in Africa. The challenge is for us as Australians, let's do it now. Let's muscle our way in and regain that market share in a green metal future.
Dino, Otranto, thank you.
Thank you very much. Thanks for having me today.